Quick reminder, this is educational analysis of historical data, not financial advice. 8 times a year, the Federal Reserve announces its interest rate decision, and traders treat it like Bitcoin's Super Bowl, a volatility goldmine you can supposedly print money on. You place a trade right before 2 p.m., price explodes, and somehow it takes out your stop in both directions before picking one, leaving you flat and frustrated. So is a Fed day actually a gold mine for Bitcoin or a trap? I stopped guessing and backtested every single FOMC decision since 2017, 68 of them, and the honest answer is not the one the hype merchants give you. Let us walk through exactly what the data says and how to actually handle these days. First, a quick foundation, so this makes sense. The FOMC is the Federal Reserve's rate-setting committee. It meets 8 times a year, roughly every 6 weeks, and on the second day, it announces whether it is raising, cutting, or holding interest rates, always at 2 p.m., New York time, on a Wednesday, followed by a press conference at 2:30. The exact dates are published a year ahead, so the entire market knows the precise minute it is coming. Hold on to that fact. Everybody knowing the exact moment is the whole reason these days behave the way they do. So, why does Bitcoin even care? The Fed sets the price of money. When it raises rates, cash and bonds pay more and borrowing gets expensive, so money drains out of risky bets. When it cuts rates or prints, money floods back toward risk. Bitcoin is the purest risk asset on the planet, so it swings hard on the direction of that tide. That is the real, honest link, no conspiracy, just the cost of money moving the most speculative asset the most. So it makes sense a Fed decision matters. The question is, how much, and whether you can actually trade it. And that is where the data gets surprising. Here is the first surprise. Everyone assumes Fed days are wildly more volatile for Bitcoin. So I measured it. Across all 68 Fed days, the average daily range was 5.6%. On a normal, random day, 4.99%. That is a ratio of just 1.12, barely 12% more volatile than any ordinary day. Let that sink in. The market's most feared event moves Bitcoin only a hair more than a random Tuesday. Why? Because Bitcoin is already wild every single day. A 5% daily swing is normal for crypto, so the Fed barely stands out on the daily chart. The gold mine of volatility is mostly in your head. So if the whole day is barely more volatile, where does the drama come from? It is compressed into a few hours. When I zoom into the hourly chart, the 6 hours right after the 2 p.m. announcement are 1.5 times more volatile than the same hours on a normal day. So the daily candle hides it, but intraday there is a violent burst. It just happens fast, right around 2 p.m., and then calms down. And here is the important part the hype skips. That burst does not just go one way. It whips. This is the single most important thing to understand about Fed days, so watch it closely. Roughly 1 in 3 Fed days, price stabs at least 1% in both directions within a few hours. It spikes one way to suck traders in, then violently reverses the other way and traps them. It does not matter which side you pick. The initial move is designed, by the simple physics of where everyone's orders sit, to grab you first. That is why placing a trade right at 2 p.m. feels like the market is personally hunting you. Let me show you 2 real Fed days, and notice they go opposite directions. Here is a real example. This is Bitcoin on January 26, 2022, hour by hour. It sits calm before the decision. 2 p.m. hits, and price pops up, a quick spike that screams, breakout, get in. Buyers chase it, and then it whips straight back down and dumps, falling nearly 6% over the next few hours. Everyone who chased that pop is now trapped in a loser. Pop, then dump. The buyers got hunted. Now the exact opposite, just 7 weeks later. March 16th, 2022. 2 p.m. hits, and this time price stabs down, a sharp drop that screams, "It's crashing, get out or short it." Panic sellers and shorts pile in, and then it rips straight back up, reversing the whole move and running higher, trapping every seller who bailed at the bottom. Same event, opposite direction, and both groups, the chasers and the panickers, got caught. That is the whipsaw. You cannot know in advance which way it stabs first. So why does it whipsaw? Remember the fact I told you to hold on to? Everyone knows the Fed lands at exactly 2 p.m. So everyone puts their stop losses and their entry orders in the same obvious spots beforehand, just above the range, just below it. That builds 2 thick shelves of resting orders, on both sides, in plain sight. When the news hits and liquidity goes thin for a moment, price naturally lunges toward the nearest shelf, grabs those orders, then snaps back and grabs the other. It is the exact same liquidity grab mechanic from stop hunts, just supercharged by a scheduled event where the whole world clustered its orders in the same place at the same minute. Here is the second surprise, and it is something almost nobody talks about. I split the Fed days by era. Back in the 2020 to 2021 money printing boom, Fed days averaged a 7.5% range, genuinely wild. Through the 2022 hiking storm, 6.4. During the 2023 pause, 5.5. And in the recent cutting cycle, just 3.5%. The trend is clear and one-directional. As Bitcoin has matured into a trillion-dollar asset, the Fed's power to whip it around has been steadily fading. The FOMC drama you remember from the wild years is quietly shrinking. So can you actually trade it? Here's the honest answer. On average, the Fed day itself closed up 57% of the time for a gain of about 1%. A mild, bullish, buy the news, lean. Tempting, right? But do not fall for it. 57% is a coin flip with a slight wobble. It is heavily skewed by the 2020-21 pump, and here is the killer. The very next day reverses that move 57% of the time. So you are trying to catch a violent, two-sided whipsaw on a signal that is barely better than random, that often unwinds the day after. The big Bitcoin moves, the real crashes and rallies, came from the macro trend playing out over weeks, not from trading the 2 p.m. candle. There is no reliable edge in the Fed candle itself. So how do you actually handle Fed days? 3 honest rules, and none of them are predict the Fed. 1. Do not trade the 2 p.m. candle. The first move is a coin flip trap designed to grab stops on both sides. Sitting it out is a position. 2. If you are already in a trade, respect the event. Size down or take some off before 2 p.m., because a normal stop can get wicked out by the whipsaw and then the trade works without you. 3. If you must trade it, wait. Let the dust settle for 30 to 60 minutes. Let price actually confirm a direction with a clean higher high or lower low that holds, and only then trade that, with a stop. The edge on Fed days is not prediction. It is patience and risk control. So, the verdict. Gold mine or trap? Honestly, mostly a trap for the impatient. The volatility is real, but it is intraday and it whipsaws both ways. The direction is a coin flip that unwinds the next day, and the Fed's grip on Bitcoin is fading year by year. There is no secret setup here, and anyone selling you a guaranteed FOMC strategy is selling you a 50-50 dressed up as an edge. The professional move on a Fed day is boring. Reduce risk, do not chase the 2 p.m. spike, and wait for the market to show its hand. Remember this one line and you are ahead of 90% of traders. This is educational analysis of historical data, not financial advice. Always do your own research and manage your risk. And that is the honest picture of Fed days. This is educational analysis of historical data only, not financial advice. Always do your own research.